Next is the intro to order execution. Here's what I'm going to cover. In the previous lessons, we cover what an option chain is. It's like the menu to analyze or order the items or options that you want. Now in this lesson, we're going to cover how to actually order and the various order types. Also, what can you do once you place an order? And finally, how to close out an order. Think of options trading like dining at a restaurant. Each decision is from assessing your budget to choose your meal, to determine how you order, to mid-meal adjustments, to paying the bill. So I'm going to get into the parallels of the key trading concepts. So here are the various stages: assessing, opening, managing, and closing. So on assessing, how much money can you spend? And what items do you want? In opening, do you want the items at a certain price? How quickly do you want the item? In managing, do you want to make any changes to your order once it's placed? In closing, how do you want to close out your order? So, key concepts with assessing: your buying power and options chain. When opening, order types like buying to open or selling to open. A key concept with management: rolling a trade. Key concept with closing: buying to close or selling to close. So let's start with assessing. So again, the key concepts with assessing: how much money can you spend? What items do you want? And the key concepts is buying power and using that options chain. So your meal budget, buying power. Before you even think about ordering something, you now need to determine how much money you have or want to spend. And this is buying power. Technical definition here: buying power in options trading refers to the amount of capital available in your account to initiate new trades, taking into account margin requirements and any existing positions. So, restaurant example: think of buying power as how much money you have in your wallet. Maybe you want to spend all your money on a meal, or maybe you want to reserve some money for other expenses. Buying power reduction. The technical definition: buying power reduction is the amount of money that gets tied up when you enter into an options trade, representing the capital requirement in your account to open and or maintain the trade. Restaurant example: when you order, imagine the waiter reserves a portion of your money to ensure that you can pay for it later. This reserved amount is like your meal budget and reduces the amount you can spend on other meals or items while you're at the restaurant. Now let's recap the menu or options chain. So here's the options chain menu. The menu offers two main dishes or items: call options or put options. Each dish has its own price or premium. It also has its own unique ingredients, like the strike price, the expiration date, and each dish also has its own popularity in the restaurant, volume, and open interest. So let's move on to opening. Opening, the key considerations: do you want the item at a certain price? And how quickly do you want the item? So the key concepts here are the order types, and then you're thinking about buying to open or selling to open. So types of orders. In a restaurant example, once you determine what type of dish you want, and if you can afford it, you now need to figure out how you are going to order the meal. That would be the order type. There are two overreaching order types that will affect the price and timeliness of your order. There's a market order. This directs the broker to execute the trade at the most favorable current price. These orders are typically fulfilled unless there's a lack of trading liquidity. They're filled right away. In a restaurant, market orders are like asking for the daily special. They're quick and at the market's price. The second is limit order. A limit order sets a specific price for buying or selling a stock or option, ensuring the transaction occurs at the price or a more favorable one. This type of order remains active until it's filled, expires, or is withdrawn. At a restaurant, this is like ordering a dish at a specific price or time. The order only executes if the restaurant, the market, agrees to your price and to your timeliness. Now, there's types of limit orders. If you decide you'd like to place a limit order, you then need to specify the limits. Often this is the price, but it also accompanies how long you're willing to wait for the order to be executed. This type of limit order is a GTC, good till canceled. A good till cancel order is a type of limit order with an instruction to the broker to keep the order active until it is filled or explicitly canceled by the trader. In a restaurant example, it's like a standing reservation. It remains active until your order is filled or you decide to cancel it. Another type of limit order is a day order. A day order in trading is an instruction to a broker that the order must be executed within the same trading day. If it's not filled by the end of the trading day, it automatically expires. A restaurant example, it's like ordering for quick consumption. It's valid only for the current mealtime. Maybe like a happy hour special would be a good example. Next, you need to determine if you're selling or buying an option. If selling, you need to sell to open a position. If buying, you need to buy to open a position. Opening your trade. So the difference between buying to open and selling to open a trade, in the restaurant metaphor, imagine this is like paying for a reservation in advance. Buying to open. It means initiating a new position by purchasing a call or a put, giving you the right to buy or sell the underlying asset. In a restaurant example, this is like paying for a restaurant in advance for a reservation, like an options contract, which gives you the right to enjoy a meal or exercise in the future. Selling to open. This involves writing or selling a call or put contract to sell to another trader, which obligates you to buy or sell the asset if the option is exercised. A restaurant example, this is like offering paid reservations for a special event. It involves them providing a contract to customers where they commit to cooking the dinner if the diner chooses to attend or exercise. There are risks associated with buying versus selling. So the risk implications. In the options world, buying versus selling to open a contract takes on unique costs and risks. So buying to open is a debit transaction. A debit means that money immediately comes out of your account to pay for something. The risk typically when buying to open is the maximum possible loss is capped since it involves acquiring an asset, eliminating any further risk. Selling to open is different. It results in a credit transaction for your account. Money comes into your account. And a credit means that you receive money up front. However, you typically have to hold collateral such as a stock or money or cash in the account. The risk to selling to open can entail significant potential loss because it can involve selling an asset that you don't currently own. So quick recap of opening concepts. When opening, you have to consider what price and how long you're willing to wait. That would be the order type. Then, depending on if you're selling or buying the option contract, that determines if you're selling to open versus buying to open. You opened a trade. Now what? You're in the managing stage. Here you need to consider if you want to make any changes to your order once it's already been placed. In the key concept in options trading, this is called rolling. Rolling a trade. In the restaurant metaphor, rolling the trade is like mid-meal adjustments. Sometimes you might want to change up your order. It's like extending or shifting your dining experience to match your changing taste or expectations. So a restaurant example, sometimes you want to change your food order. Rolling a trade is like changing your dish partway through, closing one order and opening another, adjusting your meal to your new taste and appetite preferences. Sometimes you'll pay more, sometimes you'll pay less, and other times you'll pay the same amount. The technical definition. Rolling an options trade involves closing a current options position and simultaneously opening a new one with a different expiration date or strike price to adjust or extend the trade. In essence, rolling a trade is a strategic move to modify your options position in light of evolving market conditions or objectives. You can roll a trade in time or in strike price. Adjustments in time. That would be rolling out, moving to an option with a later expiration date. Rolling in would be shifting to an option with a closer expiration date. Adjustments by strike. Rolling up, switching to an option with a higher strike price, that's rolling up. Or rolling down, that would be moving to an option with a lower strike price. Closing out your order. Now in the closing stage, the key consideration. How do you want to close out your order? So key concepts: buying to close, selling to close, or there's assignment or exercise. If you bought an option, you can sell it to close. Sell to close. If you sold an option, you can buy to close. Closing order types. In the dining example, closing orders are like leaving the restaurant. Again, there's two options: buying to close. And the technical definition, this is used by traders who have previously sold an option, for example, selling to open, and now wish to buy back the same option to close the position. The restaurant example would be like settling the bill for a table you had earlier reserved, closing a position that you had already sold to open. Now, selling to close. The technical definition is employed by traders who have bought an option, buying to open, and want to sell the same option to exit the position. So in a restaurant, it's kind of like offering your reserved table to someone else, closing a position you had bought to open. Now let's talk about option assignment. Assignment in options trading occurs when the seller of an option is obligated to fulfill the terms of the contract by either selling or buying the underlying asset at the strike price as the option buyer exercises their right. Changing up the metaphor. Buying an option, the house analogy. Remember, imagine you're interested in buying a house that's currently worth $100,000. You believe the house's value will increase, but you're not ready to buy it yet. So you make a deal with the owner, you pay him $5,000 for the option to buy the house at $100,000 and within the next year, regardless of its market value at that time. 1 year passes, and so here are the scenarios at expiration. Let's say that the house is worth $90,000. It's below the strike price of $100,000. It's below the strike price of $100,000. So you do not exercise. The buyer doesn't exercise. They're not going to buy that house. It's worth less than $100,000. Exercise leads to a loss. At the purchase price of $100,000, it's higher than the market value of $90,000. It's more cost effective to let the option expire worthless. The loss is limited to the $5,000 premium. Now, what if the house market value is right at $100,000? It's equal to the strike price. It's at the money. Do you exercise or not? Well, it depends. Exercising the option results in buying the house at market value. The decision may be based on personal reasons rather than financial gain. And the premium paid, $5,000, is a loss. So you're down $5,000 coming in. The market value, let's say the market value goes to $120,000. So it's above the strike price of $100,000. The buyer will exercise because it's financially beneficial to do so. The house can be bought at $100,000, less than its market value at $120,000. The profit is the difference minus the $5,000 premium, don't forget about that, resulting in a $15,000 gain. Now we're back in the options world. In the options world, the rules. Assignment criteria. Only in the money options that are short can be assigned. Assignment timing. Assignments do not occur during the trading day. They happen overnight. Early assignment likelihood. It's uncommon for assignments to happen before expiration, but when they do, it's often linked to the option's it's often linked to the option's extrinsic value, and we will cover this later. Reducing assignment risk, adjustments by strike, rolling up, switching to an option with a higher strike price, often used in a rising market. Another way to reduce your assignment risk is by rolling down, moving to an option with a lower strike price, commonly employed in a declining market. And another way to reduce risk is assignments in time, moving an option with a later expiration date, giving the trade more time to develop. While we're on the subject, we'll overview American style versus European style options. You can see American style, you use stocks and ETFs. And with European, you're using SPX, RUT, and NDX. Those are indexes. And your exercise rights are different. With American style, you can exercise any day at any time during the contract. With European styles, you can exercise only on the day of expiration. The flexibility. So American style is way more flexible, offering the holder the opportunity to exercise the option whenever it's favorable before expiration. The European style much less flexible due to the restrictions on when you can exercise, the exercise date. The settlement for American style, it settles to the stock. In European style, it settles to cash. The tax treatment, American style, 100% short-term capital gains, which is not as favorable. European style, 60% long-term and 40% short-term capital gains. So there's an advantage. And special notes, the terms American and European have nothing to do with the geographical locations. Both types of options trade in many places. Europe-style options are very common on American exchanges. So let's recap everything. As it relates to option order execution, there are 4 stages: assessing, opening, managing, and closing. And when it comes to assessing, you have the key considerations: how much money you can spend and what items do you want, which relates to the key concept: buying power and options chain and the options chain. As it relates to order execution, when it comes to opening, you have the key considerations. Do you want the items at a certain price? How quickly do you want the item? Which relates to the key concepts: order types, buying to open, and selling to open. When it comes to managing, you have the key considerations. Do you want to make any changes to your order once it's already been placed? Which relates to the key concepts of possibly rolling a trade. When it comes to closing, you have the key consideration of how do you want to close your order, which relates to the key concepts of buying to close, selling to close, assignment, and exercise. Here are the key terms to remember: call and put options, market orders, limit orders, buying power, buying to open, selling to open, buying power reduction, rolling a trade, assignment, buying to close, and selling to close. We'll see you in the next lesson. My new book, it's out, called All Market Trading Profits. And for those who don't know me, my name is Carl Dahm, and I'm also known as the Transparent Trader. My marketing guy, he convinced me to write a book that shares my secret trade details with you. It's the same trade I used to make $597,210 in third-party verified profits from 2019 to 2023. I'm not sure how long I'll keep these secrets in my book, so you might want to grab a copy before I change my mind. Don't miss out. In my book, I reveal the unique trade structure I developed, something you won't find anywhere else. The book isn't AI-generated content. It's real organic material. If you're interested in learning the trade that drives over 70% of my net worth, click the link in the description to get the book and see how I achieve my results. The book is $30 on Amazon right now, and I'm offering a downloadable version for only $5. See that link in the description.